For any serious investor, there's a classic problem. It's not about having access to capital. Nope. The real challenge is getting your hands on that capital without having to tear apart a portfolio you've spent years building. Well, in this explainer, we're going to pull back the curtain on a really powerful tool that's designed to solve exactly that.
So, does this sound familiar? You look at your accounts and you see significant wealth, but it's all tied up in your investments. Then, bam, an opportunity comes knocking. A new business idea, a can't-miss real estate deal, and you need cash and you need it fast. The thought of selling your best assets, though, it's just painful. It's the classic asset-rich, cash-poor dilemma.
All right, here's our game plan. We'll kick things off with that investor's dilemma, then we'll introduce the solution for unlocking liquidity. After that, we'll cover the strategic benefits, unpack the very real hidden risks, look at it from a lender's point of view, and wrap it all up with the key takeaway.
So yeah, for savvy investors, C-suite execs, this is the real rub. How do you balance your need for cash with preserving your long-term investment strategy? The most obvious answer, just sell something, is almost always the last thing you want to do.
And why is selling so painful? Well, the reasons are pretty clear. First, you've got taxes. Ouch. Second, you're forced to sell based on your need for cash, not because it's a good time in the market. That's a huge timing risk. And finally, you give up all the future growth and income from whatever you sold. It just feels like a step backward when you're trying to move forward.
So, if selling is the problem, what's the solution? Well, instead of dismantling your portfolio piece by piece, you can unlock its value. And this is where a loan against your investment portfolio, or a securities-backed loan, enters the picture.
At its heart, the idea is actually really simple. You use your existing investments, we're talking stocks, ETFs, investment-grade bonds, as collateral. In return, you get the capital you need. And the best part? Your assets stay right where they are, still working for you.
Now, I know what you might be thinking. Wait a minute, isn't this just a margin loan? It's a great question, but the answer is a big, fat no. A margin loan is usually for one thing, buying more stocks on leverage, and the rules are pretty rigid. Portfolio-backed lending, on the other hand, is for much broader needs, and the structure is custom negotiated based on your specific assets. Think of it as a tailored suit versus something you buy off the rack.
And this is a really crucial point. We're not just talking about another way to borrow money here. This is a strategic tool, something you pull out of the toolbox when timing, control, and staying in the market are absolutely critical.
So the advantages are pretty compelling. You get liquidity without having to liquidate. That's the big one. You get to maintain your entire investment strategy, keeping your exposure to all that potential market upside. These are also often structured as flexible lines of credit, and honestly, compared to other types of loans, they can be set up incredibly fast.
Let's make this super clear with an example. Picture a business owner who has a huge stock position in a public company. A new opportunity pops up that needs cash right away. Selling that stock would mean a massive tax bill and, of course, losing out on any future gains. The solution? They pledge a part of their portfolio, get the cash they need, and keep their entire position intact. It's a perfect case of holding on to a core asset while jumping on something new.
Okay, so we've talked about how powerful this is, but you know the saying, with great power comes risk. And while the loan itself seems simple, the risks involved are anything but. We absolutely have to understand them. This, right here, is the single most important question you have to ask. All of the risk, everything that can go wrong, flows from this one scenario. What happens when the market takes a nosedive?
It all starts here. A market correction hits, and the value of the assets you've pledged as collateral starts to drop. At this point, it's just a paper loss, but it's the domino that starts the whole chain reaction.
Next, that falling collateral value messes with your loan-to-value ratio, or LTV. All that means is the size of your loan compared to the current value of your collateral. As your assets drop, that ratio goes up, it crosses a line in the sand, and all of a sudden, the lender is feeling a lot more exposed.
And that brings us to the final, dreaded stage, the margin call. The lender calls you up and says you have to fix that LTV ratio and you have to do it now. That means you either have to add more assets into the collateral pool or pay down some of the loan with cash. This is truly the moment of truth.
To really master this tool, you gotta see it from the other side of the table. So let's flip the script for a second and look at what lenders are really focusing on when they decide whether to approve your loan.
This quote right here absolutely nails it. A lender isn't just looking at what your portfolio is worth today. No way. They are running stress tests. They want to know how your assets are going to behave in a worst-case scenario. Their entire world revolves around downside protection.
So what are they looking for exactly?
First and foremost, true liquidity. They don't just care about how big the company is, they care about how many shares trade every single day. Their key question is simple. If we had to sell this stuff tomorrow, could we get out quick without cratering the price?
Second on their list is concentration risk. You know the old all your eggs in one basket problem? If your portfolio is 90% one high-flying tech stock, that's a massive red flag for a lender. A single stock, no matter how good it is, becomes a huge risk in their eyes because it limits their options in a crisis.
And third, they are obsessed with downside volatility, something they call gap risk. This means they don't really care about the average day. They are laser focused on the worst possible day. How far and how fast can an asset's price just fall off a cliff? The more volatile an asset is, the less money a lender is going to be willing to lend against it. Period.
Okay, let's bring this all home. When you use this the right way, it's not about taking on reckless debt. It's about strategically using a liability to preserve your assets and protect your long-term plan.
So at the end of the day, the ultimate takeaway is this. A loan against your portfolio is a powerful tool that lets you stay in the game and maintain your exposure to market upside. It puts you in control of the timing of your big financial decisions, and it lets you get the liquidity you need, both efficiently and strategically. The structure is simple, but as we've seen, the strategy behind it is sophisticated. It's all about managing your cash needs without being forced into making the wrong move at the absolute worst time. So I'll leave you with this question. Now that you understand this tool, what opportunity that once seemed out of reach could you potentially unlock?